Everybody. Great to be here. My name is Linus Wiebe. I'm currently working as a managing partner at a VC company investing in early stage and growth companies. So I'm here to talk today about what's needed to grow a thriving company, which of course for us in what we do every day, that's exactly what we're looking for. Which are the companies that can become thriving companies, truly thriving companies, successful in all the aspects to build a company. So that's the topic for today. So when thinking about what to talk about and how to structure this, I actually started to think back throughout my own career and what have been these common traits for the companies that I believe have been thriving companies, and also some examples of where we have not succeeded to do that. Companies that were, for one reason or another, not thriving. So looking back at my own career, I started my career at working at two very technology-driven companies. One doing fingerprint recognition, another one developing a digital pen and paper technology. I will not dig deep into the tech as such, but one of the experiences or the conclusions from that is that sometimes when you are a very technology-driven company, you forget about maybe the most important aspect about building a company. Who is your customer? What problem are you solving for them? And why would they pay their hard-earned money to buy your product? So I would say that the first pillar of building a thriving company is to find your product market fit. I'll come back to a little bit to that. After that, I spent 3 years at Ericsson, and we were selling chipsets into the handset market. It was a cutthroat market. We were selling globally. We were competing with giants like Qualcomm, Texas Instruments, MediaTek, etc., etc. And we had a lot of customers. We were selling very high volumes, so we were successful in many ways. But what we did not manage to do was to have high enough margins to fuel our future development of future products and innovations. So even though there was a window where we could be very, very successful, we did not make enough money. We weren't profitable enough to invest into the future. And those 3-4 years, they taught me a lot, but they taught me the importance of ensuring that you have high gross margins if you're building a thriving company. Thirdly, I took the CEO role of a deep tech silicon IP company. So we were selling video codecs. Again, I'm not going to talk about the technology as such, but we were one of the leading players in that market. And we were selling globally and we were profitable. And eventually we sold that company to the market leader, being ARM. We were developing all the processors and etc. you have for your handsets and for your iPads, etc., etc. But the one thing we did not manage to do was to have enough predictability in our revenue, which is, of course, the sales. So we did not have enough predictability. We couldn't really bank on what was our sales going to be in the coming quarter or 2 quarters or 3 quarters. And that, to me, that forced us to be too opportunistic when we were selling the company and we were looking how to develop the product going forward. So to me, that's really the third pillar of this. Make sure that you have predictability in your future revenue and your sales. And that's easy to say. It's hard to do, but I'll come back a little bit to that. Then after that journey and joining ARM and building that division within that company, then I joined Lund University, the largest academic institution in Scandinavia, being their director of innovation, being responsible for their whole innovation and investment funnel. So we were evaluating maybe 300-400 projects every year. We were working actively with maybe 100 of those. We helped start maybe 20 companies a year, and we invested in 10. And we had a portfolio of somewhere 60, 70, 80 companies at any given time. So when you do that, when I started working there, we worked a lot with the processes, with the offering, building awareness, all of those things that you need to do in order to be successful. And that was important. But if there was one thing I learned over those 10 years, in order to truly, drive a thriving organization and a thriving business, which was what we were doing because we were driving a commercialization arm of the university, it is to affect the culture. We needed to build the right culture in our team, and that's hard in itself. But we also needed to influence the culture of a whole university with about 6,000 to 7,000 employees, researchers, professors, academics in general, PhDs, etc., etc. So that to me is the fourth pillar of building a thriving company. It's about how do you build the right culture. So going full circle, coming back to what I do today as a managing partner in a VC company, of course, I'm trying to use all those learnings to both identify the future thriving companies that we are looking to invest in, and also, of course, to help our portfolio companies to really become thriving. So a little bit of an introduction. So looking at those four pillars, it's a product market fit. It's ensuring that you have the right gross margins. It's about ensuring that you have predictability in your sales and revenue. And then finally, and I believe most importantly, build the right culture. So digging a bit deeper into this, if we start with the first one, the product market fit. So one of the companies I worked for early in my career, we had truly groundbreaking technology. And being an engineer by trade, you completely fall in love with this kind of, it's really unique. We solved a technical problem in what we thought was a beautiful way. It was efficient, it was small, it was innovative. We patented it across the globe. It was really, interesting. And a lot of other people we spoke to also fell in love with this technology. So we built a partner network with a lot of players who were in our line of business, which was digital pen and paper, were huge brands. So we had Ericsson and Nokia producing pens and selling them together with their phones. We had Logitech selling this together with their PC peripherals. We had Vodafone offering digital messaging service through their network. We had Filofax. I don't know if any of you remember that company, but they were producing paper calendars. So they were offering this as part of their offering. And we actually had Montblanc as a pen company offering digital pens because they wanted to take the step away from, old classic pens into something new. So we managed to persuade and convince a lot of big players. But we forgot somebody. So we built a company where we had a lot of money invested. I think we were a few 100 million Swedish krona invested into the company. We had great and truly unique technology. We had fantastic partnerships, major brands. But what we did not have was a product market fit. The problem that we solved wasn't really that much of a problem for the end user. So that really, truly, to me, taught me the importance of really you need to make sure that you have the product market fit and spend enough time early on your journey to identify that and really make sure that you're there. Otherwise, you may end up, as you do in this picture, trying to sell it to somebody who doesn't really get it or want it or need it. So moving on. Gross margin, that might sound, boring, numerical. It's just a number, it's a figure. Why is that important? When you build a company, when you build a thriving company, that means you're going to grow. And you're going to grow fast. When you do that, you need to finance your growth. And you can finance your growth with outside capital. You can borrow money. You can raise capital, external capital, new owners into the company. But really, if you have high enough gross margins, you can fuel your own growth. And when you invest into growth, This means that you will have to, if you're selling a product, a physical product, you need to invest in production capacity, you need to invest in inventory, you need to invest in shipping, etc., etc. And that will tie down a lot of capital. And if you're working in a business where your margins are razor thin, it's going to be very, very hard to fuel that growth yourself. You will absolutely need to raise outside capital with all the consequences of doing that, and you will also probably be very, very sensitive to any changes that happens around you. In our experience, looking to invest into companies that we believe can become thriving and growing companies, we look at opportunities where you have a gross margin of at least 60 to 70%. That tells us that you will be able to fuel your own growth to quite a high level. What it also means is that if you have a high enough gross margin, it also means that you have a unique product. You have a unique offering. What you have is something that your customers are willing to pay for. If you can't keep up your margins, you have to ask yourself, why is that? Is the value that I bring to my customers not big enough? So a gross margin is a very good proxy for a lot of other things. It's a proxy for how fast can you grow. It's a proxy for the uniqueness of your product, etc., etc. So even though gross margin is maybe a boring concept and it's figures and it's numbers and it's very digital, it is important because it's a great proxy of a lot of other qualities in your company. So that to me is the second pillar of building a thriving company. Moving on, this picture is trying to describe what I see as both the importance and the journey of going from an old school type of sales organization to a modern sales organization. And I'm sure I'm to some extent preaching to the choir here, being, I'm slowly getting used to no longer being the young person in the room. So a lot of you probably have already realized this and only worked in organizations where this is a given. But I'm continuously surprised how many organizations where it's not. So when I started working professionally, I was working in technology-based, product-driven organizations where sales was very much a relationship-based art. So you had great people who had strong relationship with customers, potential customers, and they were working the market and bringing in the contracts. And even though you had sales targets and you had sort of projections and all of that, you didn't really know until the end of the quarter how the quarter was ending. And since you didn't know that, you couldn't really plan because you always had to have buffers. You always had to be able to accommodate for missed targets, etc., etc. And also, it was a very volatile cycle where you had a lot of your salespeople who were working to close the deals by the end of the quarter. And then the first couple of weeks into the new quarter, they had to build the sales funnel again, generating the leads, etc., etc. If you look at the other end of the spectrum, where at least we see a lot of modern companies working today, they work with trying to achieve very much higher predictability in their sales, in their revenue. Imagine a world where you would know by 80% or even 90% certainty where your sales will be the coming quarter, 2 quarters, even 3 quarters. And if you also know your gross margins, and if they're high enough, and you know for how long it will take until your customers pay you, then you can basically do the calculations of exactly how fast you can grow for the coming 2, 3, 4 quarters. And if you can trust those numbers, then you will be willing to work with a lot less buffers, a lot less margins, etc., etc. And you can grow a lot faster than you otherwise could. So that's why getting a much, much higher level of predictability in your sales and revenue is absolutely fundamental in building a thriving and growing company. Part of that is, of course, to know your key performance indicators, your customer acquisition cost, your lifetime value, upsell, downsell, churn, net retention rate, etc., etc. And a lot of those KPIs are coming from the software as a service business. But actually, you can deploy those KPIs across any business, because regardless of whether you're selling software or hardware, you do have a customer acquisition cost. And even though you're selling subscription service or not, there is a lifetime value to your customers, etc., etc. So all those KPIs are relevant regardless of your type of product. And to me, this sounds like basic housekeeping, and my expectation on any company would be that they have this, they know their numbers. But we as an investor are often very surprised on how far away a lot of companies are on this. Either they don't have it, or they have some of it but not enough of it, or even in some cases they might not even understand the importance of having them. So to me, that's the third pillar of building a thriving company. Make sure that you have your sales efficiency, you know your numbers, because that will allow you to be able to grow a lot faster. Next one. So we've been talking about product market fit, been talking about gross margins, sales efficiency. Maybe the most important aspect of building a thriving company, you need to have those three that we talked about before, because they're fundamental. Without those, you don't really have a business, in my opinion. Finally, to me, it's about the culture. When you're building a thriving company long term. And throughout my career as a manager in different organizations and different roles, I've always struggled. How can I find a way to measure the effectiveness of my culture? How can I measure how committed people are, how engaged they are in what we're trying to do? How can I measure the efficiency of my organization? Which is fundamentally hard, because it's not an easy thing to measure. There's no formula on how to do it. And being married to a psychologist, I've always bugged her on this. I've asked her, I'm struggling with this. What should I do? What can I do in order to sort of mitigate this, or find the right formula in order to drive engagement and culture and positive behaviors and all of that? And being a psychologist, her answer has always been, it depends. I'm sure it does. But again, being the engineer I am, I've tried to figure this out. And that's why when a great author and researcher named Amy Diamond came up with a theory that she later popularized in the book, The Fearless Organization. This was back in 2018, so this is 7 years ago now. She actually tried to answer this question. What is it that makes a thriving organization? And of course, she has had a great impact on organizational theory and how you build this. And one of the things that she did, which was to me the most important aspect, is that she started to quantify this. She started to say, what are the key factors? How can you measure those? What are the things we need to look at? What are the things we need to drive? What are the key qualities? Performance, collaboration, learning, quality, engagement, etc., etc. And her most important theory or finding really is to build an organization where you have what she names as psychological safety. That means that people feel that they are allowed to make mistakes. It doesn't mean that there's a lenient attitude towards not caring, or that you shouldn't, try your best. But if you honestly fail on something sometimes, that's okay. Because if you don't, you're probably not trying hard enough, or you're not ambitious enough, or you're not really, taking enough risk. So we have to build an organization where people are psychologically safe in order to perform their best. And then there's a lot of theory and a lot of things around it. How do you build psychological safety? What can you do? And one of the key aspects of that is, of course, to ensure that you have employees that are engaged in your business. So we need to find ways to ensure engagement in our companies. We need to find a way to measure engagement and drive engagement. So to me, that's really the fourth pillar. How do you build a culture, and how do you ensure that you create an organization that is fearless in the good way? And how important employee engagement is into that. So to summarize, in my personal opinion, there are 4 pillars to building a thriving company, a successful company, really. You need to have your product market fit. Without that, you don't stand a chance. You need to have healthy gross margins. And honestly, in my personal opinion, unless you're running a convenience store or something like that, a healthy margin, in my opinion, is 60-70% at least, in order to be able to fuel your growth fast enough. Third one, make sure you know your numbers, your sales efficiency, and you can work on that. There's no reason why you couldn't when building an organization. And then last but not least, build the right culture, because that's what's going to enable you to withstand all the uncertainties that you're going to face and all the challenges that you don't know you're going to face, because those are the hardest ones, of course, the ones that you don't know about. And the only way to adapt and overcome that is to have the right culture in your organization. So really, to summarize it, those to me are the 4 most important aspects of building a thriving company. I see there are starting to pop up some questions in the Q&A, and really, so this concludes the presentation part of this. And I think we have trying to find where I have a clock. There's like 6 or 7 minutes for Q&As. So I'll take them from the top. So if gross margin is 60-70%, oh, here I get it displayed. Thank you, Sasha. So if we have a gross margin of 60-70%, when COGS vary a lot because of raw materials, you have a growing business, with gross margin would just sound the alarm. Yeah. In our experience, if you're working in a market where you believe you have something unique, if you have a gross margin below 50, that's an alarm bell in my book. Of course, there are businesses where that's not applicable. I mean, if you run a convenience store, an ICA store in Sweden, or a Walmart, then you're working with completely different gross margins because it's a volume business in a different way. But if you're looking for companies that are supposed to have some kind of uniqueness in their offering or in their product, a gross margin below 50% to me is a red flag. So, second question. Wow, that's a good one. I've seldom come in contact with founders with a culture HR background. Despite this, I believe many would be great CEO. Yes. That's a really good question. In my experience, when the best HR leaders, like the chief people officers, the HR leaders that are part of the management team, not reporting to the CFO or sort of behind somewhere, or they're really part of the management group of the executive team, they very often have a lot more influence than their formal roles attire. So even though their budgets are not that large, or even though they don't have a lot of direct reports, they have a lot of influence. Why do they not step up? That's a very good question. I would like to see some people with an HR background, because I've met some fantastic HR leaders in my career, and I value them a lot. And when I run into really, really hard situations, because the really hard situations that you run into professionally, in my experience, they are related to people. All else you can calculate, you can be rational about. But people are people. So the really hard questions, that's when I turn to some of the great HR people in my in my environment, in my network. So to me, it would be great if we could have some strong HR people, taking the CEO role. But I agree, it's not common. But no good answer to why that is. Did we have more questions?
Yes.
Yes. How do you engage younger employees who are looking for purpose when you're a very commercial organization? Yeah, I I was once asked to be a sort of a bouncing board for some people who were trainees in a large organization, and they asked me what was the if I were to give them one advice in their career, because they were very ambitious people, you typical management trainees, they were doing an internship of 6, 12, 18 months within this company, and they were expected to rise through the management levels. And they asked me if I give them one career advice, and I said to them that, okay, so you're asked to do a lot of things in your daily work, and you probably have a lot of opinions of how things could be done better or different, etc., etc. So when you think about how to give that feedback to the rest of the organization as a junior employee, think about the difference if you do the work that you're expected to do, and you deliver your suggestions on top of that. Or on the other hand, if you don't do the work that you're expected to do because you think something else is wrong, and that's the feedback that you deliver. Even though your feedback might be equally important and equally right, you will be listened to a lot more if you also actually do what you're expected to do. And that's not a direct answer to the question, but I think there is something into that. And I think when you employ younger people in your organization, you have to allow them to give a lot of feedback, but also, convey to them that the impact of their feedback and their influence in the organization is also tied to the delivery to the organization, because those two go hand in hand. The ability to influence comes with the willingness to take responsibility and to deliver. So not a direct answer, but trying to address that, because I know it's challenging sometimes with a very, very purpose-driven younger generation. We as employers, we have to give them both, a sense of purpose, as well as actually getting the best out of them as professionals and getting them to deliver to the full capacity. Would you ever consider outsourcing change? Yeah. You can probably get outside help on sort of doing some kind of implementation if you know what you want to do. But to bring in an outside consultant and ask them to do your change management for you, to me, is a recipe for failure. You have to own it yourself as the management team. Even if you don't, do all the legwork yourself, you have to own it. You have to be the person standing on stage explaining why this is important and why we're going to do it and how we're going to do it. And then you can point to some outside people to help you implement it. But they can't do it for you. Culture is what's in all of us. And you can't ask an outside person to change the culture in your company. It's not going to happen, in my experience. So we've got 1 minute left. Do we have any final questions, Asha? Or is it a wrap at this point?
Wrap.
Yeah. So thank you, everybody. Great to have the opportunity to talk about something I care about. I hope that came across, and looking forward to seeing you all at different occasions going forward. Thanks.